Steve Leisman, CNBC. Is every reason to expect, Madam Chair, that the PCE inflation rate, which is followed by the Fed, looks likely to exceed your 2016 consensus forecast next week? Does this suggest that the Federal Reserve is behind the curve on inflation? And what tolerance is there for higher inflation at the Federal Reserve? And if it's above the 2% target, then how is that not kind of blowing through a target the same way you blew through the 6.5% unemployment target, in that they become these soft targets? Thanks.
Well, thanks for the question. So I think recent readings on, for example, the CPI index have been a bit on the high side, but I think this data that we're seeing is noisy. I think it's important to remember that, broadly speaking, inflation is evolving in line with the committee's expectations. The committee has expected a gradual return in inflation toward its 2% objective. And I think the recent evidence we've seen, abstracting from the noise, suggests that we are moving back gradually over time toward our 2% objective. And I see things roughly in line with where we expected inflation to be. I think if you look at the SEP projections that were submitted this time, you see very little change in inflation projections of the committee.
What about tolerance for higher inflation?
Well, the committee has emphasized that we have the 2% objective for as a longer term matter for PCE inflation, and we would not willingly see a prolonged period in which inflation persistently runs below our objective or above our objective, and that remains true. So that hasn't changed at all in terms of the committee's tolerance for permanent deviations from our objective. And we continue to see the data coming in, abstracting from the noise, in line with what we had expected, and continue to see a gradual pickup over the next several years toward our 2% objective.
Robin Harding from the Financial Times. Madam Chair, could you comment a little bit more on the decline in the long-run interest rate projection? Is that more to do with temporary headwinds from the recovery, or is it something more permanent about the economy? And is this decline to 3.75%, or do you think there is potential for this rate to go lower yet? Thank you.
Well, you do see a very slight decline this time in the committee's longer-term normal rate of interest projections. You know, I would caution you, however, we've had turnover in the committee, two new participants who joined and are submitting projections, and two who departed, and that can create changes in the projections, small changes that are difficult to interpret. But I think it's fair to say there has been a slight decline. And I think, you know, the most likely reason for that is there's been some slight decline in, as I mentioned in my opening statement, of projections pertaining to longer term growth. And typically estimates of the longer run normal federal funds rate or short-term interest rates would move in line with growth projections.
Hi, Ilan from the Washington Post. My question is sort of the flip side of Steve's, and it's about your outlook for unemployment. Your predecessor has said that the Fed has been consistently too pessimistic about the level of the unemployment rate, and today you guys lowered your outlook again. Can you tell me a little bit more about how you see the unemployment rate evolving to meet your forecast, why you believe the rate of decline will start to level off, and what an unexpected drop might mean for the first rate hike?
So it's true that unemployment has declined by more than the committee expected, and you do see a small downward revision in the committee's projections, at least the central tendency for the unemployment rate. Now, first of all, I mean, the labor market, I think, has continued to broadly improve. We have seen continued job growth at a pace that is certainly sufficient to be diminishing labor market slack over time. Over the last 3 months, for example, payroll employment has been rising around 230,000 jobs per month, and we're running close to 200,000 over the last year. So it's in no way surprising to see a decline in the unemployment rate. That said, many of my colleagues and I would see a portion of the decline in the unemployment rate as perhaps not representing a diminution of slack in the labor market. We have seen labor force participation rate decline. And while I think most of us would agree that there has been and will continue to be secular decline in the labor force participation rate for demographic reasons, I think a portion of the decline we have seen in the unemployment rate probably reflects a kind of shadow unemployment or discouragement, a cyclical part of labor force participation. Now, if that's correct, we may see that as the economy picks up steam and we see further recovery in the labor market, that those, let's call them discouraged workers, will return either to unemployment or to employment. And as labor force participation begins to stabilize, the unemployment rate will come down less quickly. And I think for a number of people, that's a component of the forecast. You asked about implications for the path of policy, and I would just say the guidance that we have given, our forward guidance states that the timing of liftoff will depend on actual progress we see and the progress we expect to see going forward in terms of achieving both of our goals, namely maximum employment and our 2% inflation objective. So we're not going to look at any single indicator like the unemployment rate to assess how we're doing on meeting our employment goal. We will look at a broad range of indicators. That said, as I tried to emphasize in my opening statement, there is uncertainty about monetary policy. The appropriate path of policy, the timing and pace of interest rate increases ought to, and I believe will, respond to unfolding economic developments. If those were to prove faster than the committee expects, it would be logical to expect a more rapid increase in the Fed funds rate, but the opposite also holds true. If we don't see the improvement that's projected in the baseline outlook, that the opposite would be true, and the pace of the timing and pace of interest rate increases would be later and more gradual.
John Hilsenrath from the Wall Street Journal. Chair Yellen, some Fed officials and some market commentators have noted that market conditions recently have looked a little bit like they did last spring before a period of turbulence. Volatility is very low in stock and bond markets. Risk premiums are very low. And in particular, the market expectations for interest rates, for short-term interest rates, look below even the Fed's own projections as laid out in your dot plot. I wanted to ask two questions related to that. One, what is your read on these on market activity, and are you at all concerned about the sense of complacency in markets? And two, what is your view on market expectations for the rate hike cycle that the Fed has laid out in its dot plot? Or is the market where you think the Fed is on that?
Well, I mean, I'd start by saying that volatility, both actual and expected in markets, is at low levels. The FOMC has no target for what the right level of volatility should be, but to the extent that low levels of volatility may induce risk-taking behavior that, for example, entails excessive buildup in leverage or maturity extension, things that can pose risks to financial stability later on, that is a concern to me and to the committee. I don't know whether a number of reasons have been cited for what we're seeing in the marketplace. I don't know if overconfidence or complacency is one of those reasons, but I guess I would say it is important, as I emphasized in my own opening statement, for market participants to recognize that there is uncertainty about what the path of interest rates, short-term rates will be, and that's necessary because there's uncertainty about what the path of the economy will be. And I want to emphasize, as I have, that the FOMC will adjust policy to what it actually sees unfolding in the economy over time, and that necessarily gives rise to a certain level of uncertainty about what the path of rates will be, and it is important for market participants to factor that into their decision making. You asked me about the dot plot. Our forecasts are projections for the Fed funds rate, and you do see a range of disagreement among the participants there. So by the time you get to 2016, there is a considerable range of opinion, and I think in part that reflects the uncertainty that I'm talking about, that participants do see different pace of recovery, different trajectories for inflation, and it's appropriate for them to adjust their thinking about what the path of policy should be to their own view of how the economy will evolve over time. And around each of those dots, I think every participant who's filling out that questionnaire has a considerable band of uncertainty around their own individual forecasts.
Ben Applebaum, New York Times. You've spoken about the sense that the recession has done permanent damage to the economic output, and you've reduced gradually over time your forecast of long-term growth. I'm curious to know to what extent you think stronger monetary and/or fiscal policy could reverse those trends. Are we stuck with slower growth? Is there something that you can do about it? If so, what? If not, why?
Well, I think part of the reason that we are seeing slower growth and potential output may reflect the fact that capital investment has been very weak during the downturn and the long recovery that we're experiencing. So a diminished contribution from capital formation to growth does make a negative contribution to growth. And as the economy picks up, I certainly would hope to see that contribution restored. So I think that's one of the factors that's been operative. Of course, we've had unusually long duration unemployment. A very large fraction of those unemployed have been unemployed for more than 6 months. And there is the fear that those individuals find it harder to gain employment, that their attachment to the labor force may diminish over time, and the networks of contacts that they have that are helpful in gaining employment can begin to erode over time. We could see what's known as hysteresis, where individuals, because they haven't had jobs for a long time, find themselves permanently outside the labor force. My hope would be and my expectation is that as the economy recovers, we will see some repair of that, many of those individuals who are long-term unemployed or those who are now counted as out of the labor force would take jobs if the economy is stronger and would be drawn back in again. But it is conceivable that there's some permanent damage there too, to them, to their own well-being, their families' well-being, and the economy's potential.
Thank you, Madam Chair. I believe you mentioned in your opening remarks tighter credit. And I'm wondering what you think of the possibility that the Federal Reserve itself, with the regulations it has to impose under Dodd-Frank, is partly responsible for that. And second, the current trend toward litigation. I recently read something where just the three largest banks in the U.S. have paid $51 billion in fines so far. And obviously, the number's rising. So why would anybody loan to a near-prime borrower? And in fact, if you look at Federal Reserve Bank of New York research, here we are 5 years into the expansion, and people below FICO of 700 are having worse credit experiences. So it probably isn't because, unemployment's declining. It's probably because banks simply don't want to take the risk. So as the nation's top bank regulator, what can you do to fix that?
So I first would start by saying that I really think it's essential in the aftermath of this crisis to strengthen financial regulation and to make the financial system more robust and to reduce systemic risk. We can see what the costs of the financial crisis were, and I don't think any of us should want to see that repeated. So I think the regulations that we've put in place, most of which followed from Dodd-Frank, are highly appropriate to create a more robust financial system. It will be a safer and sounder one for our economy going forward. And I think we're making progress on doing that. In putting regulations into place, we've tried to phase them in a way that gives long enough lead times to make sure that in strengthening the financial system, we don't produce a credit crunch. And by and large, my own assessment is that credit is broadly available in the economy. But there are some exceptions, and I would agree with much of what you said when it comes to mortgage credit. I think banks at this point are reluctant to lend to borrowers with lower FICO scores. They mention in meetings with us consistently their concerns about putback risk, and I think it is difficult for any homeowner who doesn't have pristine credit these days to get a mortgage. I think that is one of the factors that is causing the housing recovery to be slow. It's not the only one, but I would agree with that assessment. And of course, there were a lot of practices in connection with mortgage lending that really need to be changed. We don't want to go back to those days, but it is important to clarify, for us to work to clarify the rules around mortgage lending to create an environment of greater certainty for lenders to be willing to extend mortgage credit.
Good afternoon, Jason Lang with Reuters. Chair Yellen, the Fed has slashed its growth projections for this year, and you've gone to pains to explain that there is uncertainty in the path of interest rates in the economy, and yet the Fed's central tendency projections for 2015 and 2016 remain quite strong. Are you confident that the U.S. economy has entered a period of sustained above-trend economic growth? Thank you.
Well, when you say confident, I suppose the answer is no, because there is uncertainty, but I think there are many good reasons why we should see a period of sustained growth in excess of the economy's potential. We have a highly accommodative monetary policy. We have diminishing fiscal drag. We have easing credit conditions. We have households who are becoming more comfortable with their debt levels and more able to service debt, an improving job market. We have rising home prices and rising equity prices, and an improving global economy, at least in my estimation. So I think all of those things ought to be working to produce above trend growth, and I think that's what's reflected in the forecasts. But nevertheless, as I said, of course there is uncertainty around that projection. Nevertheless, the labor market has continued to improve, and over a number of years in which admittedly growth has come in at a disappointing level, we've still seen the labor market broadly improve, and I expect that to continue.